So let's start with this because you bring something to this world as far as real estate syndication goes that no one really talks about. This is more of the legal and compliance side.
Yeah.
And for me, I use social media to basically, raise money, brand awareness. I think it's a very powerful tool. And I look around at the people that are also doing that, and I get frustrated because it feels like they're saying things that I'm not allowed to say.
Fair.
Yeah. How bad is it? Like when you're on social media and you find let's call it a real estate influencer, do you look at the things they say and go, ooh, can't say that? Or do you go, you're going to get screwed here. You're just living on borrowed time. Like how bad is it?
It's a little bit of both. I actually started this series called Roast That Post, and then I stopped because it was going to piss people off, where I'm like, oof, you shouldn't say that, right? And for our clients, we advise them, here's what you should and shouldn't say. Here's what you absolutely cannot say if you want us to represent you. And a lot of people like to kind of walk that line, right, of, I'll just see what I can get away with kind of thing. And the answer really is, do you want to be looking over your shoulder and worried about it when the SEC goes, this is the thing that we're going to pick on today, right? And the SEC is like any other regulatory body, as you know, and it depends on what they're in the mood for at that time. It's what's sexy to enforce right now. And it might be that one day it's taken down influencers who are saying too many things. I don't know when that's going to be. I can't tell you. But I can tell you that there's plenty of success to be had by saying within the guardrails we set for you that there's no reason to be worrying about it. The things you're saying, you're getting your deals funded, aren't you?
Yeah.
Yeah.
Yeah. Yes. But that's not without frustration.
Sure.
Right? Because like look, we're all playing in the capitalist structure, right? And in capitalism, it's competitive.
Yes.
And so regulation allows you all to play in the same game, kind of have the same rules applied to one another. But when you're not able to compete because you're following a set of guidelines that other people aren't following, that's frustrating, right? Especially on social. Like if I'm promoting a deal and maybe it's a 20% IRR, let's say, and somebody else next to me is promoting a 30% saying that, he's going to guarantee that he gets your money back and you're going to be wealthy and you're going to live this lifestyle, and I can't do that. Is he going to get more of the capital out there than myself?
Maybe, but you're playing the long game. Do you want to know how many calls I've had over the past 2 years? In 2021, you could trip over a property and everybody was making money and everybody thought they were a genius, right? 22 comes along and people are like, oof, I don't know. You're a real operator. And I'm not going to say that people who say things on social media that's a little bit, bigger than they should be saying aren't good operators, but I'm going to say some of them aren't. And you're playing the long game here. It is going to come back to haunt them eventually. It just will. Yeah. You can't promise any kind of returns because you can't. You know this, right? And what happens when insurance rates go up and interest rates go up and, multifamily starts taking a little bit of a nosedive for a little while. You've got to be in this game where you can stick that out. We know it's going to turn around. Right. It always does. But you've got to be able to stick it out until it does, right? And some of these operators that are being sort of sensational, they're not going to have the staying power. And so, unfortunately, some investors are going to get hurt, and you're eventually going to scoop them up.
Right.
So while it's frustrating today, it's going to keep you in the game longer.
Yeah, that's true. I totally agree with you. I think sometimes the frustration I have is on certain words, right? Mm-hmm. Like
me too.
like I like saying, this is a great deal. I think it's a great deal. I can't say that.
You sure can. I think it's a great deal. I think this is our plan is so solid. I think this is a great deal. No guarantee. And then there's a little asterisk. I can't guarantee you that you're going to get a 30% or 20% or 15 or any return at all.
I like that.
Yeah,
ooh,
it's all in the asterisk.
Austin watches this. This is
yeah.
Okay. All right.
I believe, we plan to, we intend to.
Can I say exceptional? This is an exceptional deal.
You can say, I believe this is an exceptional deal.
Fair,
we
fair,
have
fair.
an exceptional team.
Fair.
Right?
Fair. So for people that are doing their first deal and thinking about using other people's money, do you encourage that, or do you tell people to do one first before they use other people's capital?
I encourage people to do one first Or if you can, and I don't want to sound, if you can be passive in a deal, if you have the money to be passive in a deal, I actually recommend doing that first. Because then you can learn, what did I like about investing with someone else who was on the hook for this? What did I like about how they communicate with me? And you kind of learn, how did they present this deal to me? And so if you are able to do it, I think you should be passive first. But if not, my best operators are ones that kind of, they rolled up their sleeves and they did it first, even if it's just like a single family flip. I shouldn't say that's a big deal. It's a good investment. It's not a bad investment.
It's much easier than a multifamily.
Right. And it's a good way to cut your teeth and get started. What I saw over the past few years was a whole bunch of people learning how to do this by learning how to raise money, and that is a dangerous game. Because you don't know how to run the business yet. And all these gurus that are out there selling those $25,000 courses are telling you how to find deals and how to raise money, and then they're gone when it's time to operate.
Got it.
That's a problem.
Yeah, that is a problem.
Yeah.
That absolutely is, especially
where
when
the
times get
returns
hard.
are made, is in that up. It's not sexy,
Yeah.
but it's got to be done.
That's right. Okay, so what about friends and family? Let's say you've done a handful of flips and you've got your uncle and your brother and everybody saying, I want in. Do you let them in?
I don't, personally.
Why?
I don't love it. One is, my family's not accredited, which means most of them are not accredited. Sorry, fam, they're just not. So the liability is a little bit higher when people aren't accredited. You owe them a lot more risk disclosures, a lot more hand-holding. They're going to be sometimes less sophisticated. And the rules are there to protect them more than your accredited investors, right? Or your already wealthy investors. It sucks that that's the system we're in, but it's the system we're in. And I think, for me, I don't want to deal with the unsophisticated well, they always have to be sophisticated at least. So there's that one, as I'm not sure my friends and family are going to be sophisticated enough to do this. I hope they don't watch us. And they know who they are. So I personally don't. Now, I know there's lots of people that do, and I know that's somebody's first line of defense a lot of times. It's like, you've got to go to who you know. A few people, but you still have to vet all your investors, especially your friends and family. So if you're willing to do that and just understand that not all money is good money, and somebody who is really scared of this and isn't quite sure yet probably needs to watch you do this a couple of times before they should be doing it.
Yeah, you're right. I always, I took the family friends approach in the beginning. You know that. Yeah. And for me, it was more out of, I think, necessity. Like, I had an idea. I had really no backing. The people that were more sophisticated were looking at lack of experience and going, you don't have experience. And so that felt like my only option. Like, get the people who know me, know my character, and get them to rally behind me. And so what I don't ever know is that you're playing there's a balance game, right? Like, do you take capital that's more of a headache because that's the only capital you can get? Or do you wait until less needy capital is at play? I don't know. Like, I chose the other one. Now I'm at a point I can be much more picky. Like, I am fine saying no, and the dollar amount is almost irrelevant. But that wasn't the case in the beginning.
And I'm going to say something, a little bit of backpedaling actually, but maybe something unpopular, is because I am passionate about people creating wealth who don't already have it, I'm going to say, if that's where you're starting, then start. It might be a little bit more of a pain in the ass. It might be a little bit. It will be
a pain in the ass, just so you know.
But
it is.
Could be worth it if you really do the work.
Yeah.
Though you've got to be in it and ready. I mean, you really did the work, and it turned out to be a good deal. Or at least, even if not you, but other people, even if the deal goes sideways, if you do all you can do and you've disclosed everything and you've done all the things, even a bad deal can still end up okay, and everyone can still be friends. Everyone's still okay at Thanksgiving or whatever.
That's the big one, though. When you lose people's money that you see on a regular basis, you want to make sure that you're not ruining a relationship that is. There's not a dollar amount worth ruining.
That's right. That's right.
I know, and that was funny because that's something I said this was 2011, like when we did this pitch. I told everybody, there's a good chance I lose your money. And it's so fascinating. Like, part of me feels like part of that pitch actually worked. Like, hey, this is a great idea. There's a good chance I lose your money. So don't give me anything you're not willing to lose.
Exactly. And
And
people, you
so
have
many
to say
people
that
gave us
anyway.
money.
Yeah, you have to say that anyway. In some form or fashion, you have to say that, right?
You do, but what I found is when you're talking about an opportunity, you feel the pressure to talk about all the good in it, and you're scared to talk about the things that could go wrong because you naturally feel like that's going to make it a no for the investor, right? Especially in the beginning.
Yeah.
Then you get to the point where you're like, I don't want a bad investor. Like that becomes so valuable for you that you're like, hey, let me open up this deal. Let me show you all the things that can go wrong. You know?
Yeah.
But
because you want to get to know if it's no.
yeah, that's right. That's
Yeah.
right. But for me, we that was a good scenario for us. Like we sold that business for a very large multiple. So that was a good scenario. But like, look, I ran it back. Like when I started this company, I hit all my friends and family. You guys want in again?
Yeah.
You know? So, but I would say that my friends and family are not the neediest in the sense of they don't call me every week asking for information. Like I've built enough trust with them that they let me do my thing now. And they still get the same reports that our investors get. But I don't know. I think about that one often because I'm scared to tell people, include friends and family, but like I've done it.
I know.
You know,
It's tough.
it's a tough
and I'm
one.
with you because obviously my lawyer hat is like, you're just, there's potentially more liability there just in life, right? I mean, legally speaking, you owe everybody the same thing, but you have to see them at Thanksgiving or whatever. But also then I'm like kind of talking out of both sides of my mouth because I'm like, at some point you just got to go and do it.
Yeah.
If you're going to try to create wealth and you don't already have it, I didn't. I came from zero money, right? I had to figure out some other way. Some people, friends and family is the only way that they can get started. And if that's the case, get started.
Yeah.
Don't use that as an excuse to not start.
Yeah, that's right. So we mentioned this in the beginning, the creating an LLC on LegalZoom. Or is it LegalZoom, right?
LegalZoom, yeah.
What about creating an LLC for each rental property? Is it important to create an LLC for each one, or can you just buy them and put some insurance and call it a day?
Yeah, gosh, the typical lawyer answer, it depends. So it depends on the value, right? And the risk. You have to weigh the risk. So if you're buying a few single family properties and they're a few $100,000 each, probably not going to be in California, but if they're, you can maybe lump a few of them together in the same state. You can lump a few in the same LLC, put some insurance on it and call it a day. So if you've got some, I have a client who's got some properties in Arkansas, which are like $60,000. You don't need a separate LLC for every $60,000 property. You can get some insurance and put it together. But what you're really trying to do when you create those LLCs is basket your potential liability. And so if you put too much into one and there's a slip and fall at one, it's going to feed off of, or something happens at one, it's going to feed off of the value of the others, which is why you want them separate. So everything within that same LLC is equally at risk, whether it's equally risky. So that's the reason for separating us. You have to balance that out of what do I think my risk is here, dollar-wise, and just in the world. Like, is this a more dangerous property? Is this a more dangerous business? Whatever. And you can separate it out that way. So
What about not putting it in an LLC, just buying it personally? Would you recommend doing that?
no, I don't. No.
If you're a real estate investor, do not buy a piece of property without an LLC.
Yeah, that's right.
Why?
Because you really want to protect your personal liability and you want to treat this like a business. If you're gonna be an investor and you're gonna treat this like a business, treat it like a business and put it in an LLC. And an LLC is not the only. You still have to get insurance though.
Right.
Actually, insurance is your best line of defense, even over an LLC.
But you like having some separation?
I do.
Yeah.
Yeah. And then treat it like it's separate. Don't treat it as your own personal bank account. Don't pay it out of your own account sometimes and out of the LLC account another time, or just take money out of it. I mean, it's got to treat it like a business. This is a business. So we're all grown now. If you're going to have a business, have a business.
I like that. Yes. If you're going to do it, do it.
That's right.
If not, just skip it.
Right.
So using other people's money, this is something that I didn't understand when I was young. I always thought like you had to have money to go make money. And my first experience was when we started the brewery, raising money from investors, right? And then I started hearing everybody talk about, OPM and this is the way to do it. Why do you think that most people aren't taught that you can use other people's money to build wealth?
I think it's a specific mindset of that you can or get to do that. When I was younger, it would never have occurred to me because that was something that already just like rich people already did and we weren't rich. And so it was like, You don't get to do that. Debt is a bad thing.
Right.
And I think part of it's a mindset thing and also just an education thing. I mean, we're taught, I don't want to get into a whole like political discussion about our education system, but we're taught how to be worker bees, right? We're not taught how to be entrepreneurs. We're not taught. So why would you even need to think about using other people's money to build something when your job is to work?